Welcome to Multnomah Group's fourth quarter 2025 market commentary. I'm Caryn Sanchez, a senior investment analyst with the firm. Our first section is on the economy. The fourth quarter was shaped by a historic 43-day federal government shutdown, which created a broad blackout in official U.S. economic data and temporarily halted normal operations across key statistical agencies. During this period, the Bureau of Labor Statistics paused most releases, while the Bureau of Economic Analysis delayed national accounts reporting, leaving October as a lasting blind spot for several key data sets. GDP rose at an annualized pace of 4.3% in the third quarter of 2025, up from 3.8% in the second quarter. This was supported by broad consumer spending, exports, and government outlays, while a decline in investment provided a partial offset. Overall, the composition of growth points to continued resilience in household demand and steady contributions from the public sector, even as business investment softened. GDP has been pressured by increased inventories and rising imports. However, consumer spending, a major component, remains positive at 2.4% in the third quarter. Labor conditions cooled but remained orderly by year-end. Non-farm payrolls increased by 50,000 in December 2025, and the unemployment rate held at 4.4%. Average hourly earnings rose 0.3% month over month and 3.8% year over year, indicating moderating but still positive wage growth. Demand for workers continued to rebalance. JOLTS reported 7.1 million job openings as of November 2025, down about 885,000 over 12 months. With hires and total separations each near 5.1 million and the quits rate edging up to 2%, we see a pattern consistent with a low hire, low fire environment. The University of Michigan surveys of consumers track sentiment, conditions, and expectations. Sentiment generally moves with economic and market trends. Household views improved modestly to start 2026. The University of Michigan's Index of Consumer Sentiment rose 54 points in the preliminary January reading, its highest level since September 2025. The gain was concentrated among lower-income households, while sentiment slipped for higher-income consumers. Despite the uptick, overall sentiment remains nearly 25% below January 2025 levels, reflecting ongoing sensitivity to kitchen table issues such as prices and a cooler job market. The Consumer Price Index tracks consumer price changes. Core CPI removes volatile items. Through December 2025, headline CPI increased 2.7% year over year, with core CPI up 2.6%. On a monthly basis, headline CPI rose 0.3% and core CPI 0.2%, led by a 0.4% gain in shelter and a 0.7% increase in food prices. This slide summarizes the BEA's Personal Consumption Expenditures Report for October and November 2025. This data was released together on January 22, 2026, after shutdown-related delays. Through November, PCE inflation remains moderate but sticky, steady 0.2% for November and roughly 2.8% annualized for both headline and core. Next, we turn to the fixed income markets. The Federal Reserve cut rates 3 times in 2025, September, October, and December, citing softer labor market conditions and inflation that, while easing, remained above target. The final move brought the federal funds target range to 3.5% to 3.75% as of December 10, 2025. The yield curve has steepened over the last 12 months due to Federal Reserve rate cuts and ongoing economic growth. The adjustment supported bond returns and broader market sentiment heading into 2026. Most fixed income sectors delivered positive results for the quarter, helped by falling rates and an improving inflation backdrop. Emerging markets debt led with a 3% gain, followed by mortgage-backed securities at 1.7%. Developed international bonds were the only major segment in negative territory, down 2%. For the 1 year period, returns were healthy across all sectors, led by emerging markets debt up 13.5% and mortgage-backed securities and high-yield debt both up 8.6%. Cash was the lowest performing sector with a return of 4.3% for the period. Overall, the late 2025 interest rate environment steadied returns across many parts of the bond market. Turning to U.S. and international equities markets, the S&P 500 rose 2.7% in the fourth quarter and finished 2025 up 17.9%, reflecting a broadly supportive environment despite periods of uncertainty. Leadership varied. Healthcare gained 11.7% in the quarter, and communication services advanced 7.3%. While more rate-sensitive areas like real estate and utilities declined 2.9% and 1.4% respectively. For the 12-month period, the S&P 500 returned 17.9%. Communication services led with a return of 33.6%, reflecting strong results among media and technology-enabled firms, while the technology sector itself rose 24%. More defensive areas, such as real estate and consumer staples, posted modest gains, 3.2% and 3.9%, as higher rate sensitivity and slower growth profiles weighed on results. Overall, sectors connected to digital services and innovation outperformed, while more rate-dependent or slower-growing segments lagged. Performance across size and style differed meaningfully in 2025. Large value stocks posted the strongest fourth quarter gains at 3.8%, supported by steadier earnings and lower interest rate sensitivity. Mid-cap growth was the only segment with a negative quarter, down 3.7%, as investors favored firms with less reliance on distant future growth. Over the full year, large growth led with an 18.6% return, while mid-cap growth again trailed, rising 8.7%. The pattern suggests investors gravitated towards larger established businesses, especially those with technology and innovation exposure, amid shifting rate expectations and uneven data. Outside the U.S., results were strong. In the fourth quarter, developed international markets rose 5.3%, and emerging markets gained 4.8%, both outpacing the U.S. equity market's 2.4% return. Regionally, Latin America led with a return of 8.4%, followed by the UK at 7%, while the Pacific region increased just 2.2%. Over the 1 year period, emerging markets and developed international markets climbed 34.4% and 32.5% respectively, highlighting how improving global growth prospects, stabilizing inflation, and supportive monetary policies abroad benefited international shares. Finally, we turn to our market outlook. The past year has been a story of news headlines moving markets. While the S&P 500 saw a gain of 17.9%, this came with a lot of short-term volatility. We can expect uncertainty to rear its head again with geopolitical tensions, trade wars, new inflation and job numbers, Fed rate speculation, and still evolving AI market themes. The past year illustrated the Fed's challenge. Inflation eased but remained above their 2% target. while the job market cooled. Entering 2026, the environment is still mixed, and the pace of any further policy adjustments will depend on incoming data. The Fed's projections and several market strategists anticipate limited additional easing this year, with debate over timing and magnitude given the balance of risks. The federal deficit remains in focus as the current level is $1.8 trillion. The most recent government spending package runs out at the end of January. Protracted budget negotiations could create market uncertainties. This chart compares equal-weighted and market-weighted S&P 500 indices. Since 2019, the largest 50 companies of the S&P 500 have returned 230%, besting the S&P 500 equal weight index return of 109% and the core S&P 500 index return of 173%. Much of the gains can be attributed to FANG stocks, Meta, Amazon, Apple, Netflix, and Alphabet, and in more recent years, the Magnificent Seven, composed of Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Investors continue to watch whether U.S. equity leadership broadens beyond a handful of large, technology-oriented companies. The key question for 2026 is whether AI-related momentum persists or new themes emerge as economic conditions evolve. This closes our quarterly market commentary for the fourth quarter of 2025. Thank you for listening.